In March 2020, a number appeared on trading screens across Wall Street. The number was 125. It represented how many ounces of silver you needed to buy a single ounce of gold. This ratio had never reached this level in recorded history, not during the Black Death, not during the collapse of Rome, not during any war, famine, or financial panic in 5,000 years of precious metals trading. 3 weeks later, the Federal Reserve announced unlimited quantitative easing. Global markets collapsed. Governments locked down entire economies. The ratio had signaled a crisis before a single headline appeared. Your financial advisor never mentioned this number. Your economics professor never wrote it on the board. CNBC never put it on screen during market coverage. The gold-silver ratio remains invisible to 99% of investors. It has predicted the severity of every major financial crisis since 1971 with documented accuracy. The data sits in public archives. Anyone with internet access sees it. Almost no one reads it. This ratio does not measure the price of gold. It does not measure the price of silver. It measures something far more valuable. It measures fear. It measures the precise moment when institutional money abandons industrial assets and sprints toward monetary safety. It measures the structural pressure building inside financial systems before those systems crack. Gold did not rise to 125.1 against silver because gold became more valuable. Gold rose because silver became worthless in the eyes of frightened capital. Silver carries industrial exposure. 50% of silver demand comes from manufacturing and technology. When institutions see recession, they dump silver. When they see systemic collapse, they hoard gold. The ratio captures this behavioral divergence in a single number. The wider the ratio, the greater the institutional fear. The faster the ratio expands, the closer the crisis. Welcome to Rashi Historical. We follow the money, trace the power, and expose the history they never taught you in school. The gold-silver ratio connects your retirement account to decisions made in 1971. It connects your mortgage rate to trading patterns established in 1980. It connects your purchasing power to the same structural forces driving inflation through your grocery bill right now. This is not ancient history. This is the operating system running beneath every financial market you participate in. The ratio sits at elevated levels as you watch this. The pattern suggests another crisis approaches. Understanding the 50-year history of this indicator gives you the same information central banks and hedge funds use to position their capital before markets move. The next 5 chapters trace this ratio from Nixon's gold window closure to the present day. You will see how the ratio predicted the 2008 financial crisis 18 months early. You will see how it forecast the 2020 crash with 3 months of warning. You will learn to read the signal yourself using free public data available to anyone. The institutions reading this ratio manage trillions of dollars. They do not share their analysis on television. They act on it quietly, positioning before retail investors understand what approaches. Your understanding starts now. The gold-hush-silver ratio existed for millennia as a fixed number determined by governments. Ancient Egyptians set it at 5.1 around 3000 BCE. The Roman Empire fixed it near 12.1. Medieval Europe maintained ratios between 10:1 and 15:1. The United States established a legal ratio of 15:1 with the Coinage Act of 1792. These fixed ratios reflected political decisions, not market forces. Governments decided how many silver coins equaled one gold coin. The ratio served as monetary policy, not a crisis indicator. Everything changed on August 15, 1971. President Richard Nixon closed the gold window, ending the Bretton Woods system permanently. Foreign governments lost the ability to exchange dollars for gold at the fixed rate of $35 per ounce. Gold became a freely traded commodity for the first time in American history. Silver had already lost its monetary status in 1965, when the U.S. Mint removed silver from circulating coinage. Both metals now floated on open markets, their prices determined by supply, demand, and institutional behavior. The gold-silver ratio became a free market signal on this date. It began measuring something governments had suppressed for centuries. It started measuring the relative fear of financial institutions and the structural health of the global monetary system. Within 4 years, the ratio swung from 17:1 to 46.1 and back to 16:1. These wild oscillations reflected the chaos of a monetary system finding its new equilibrium. Gold prices rose from $35 to $195 per ounce between 1971 and 1974. The COMEX exchange began trading gold futures in December 1974, creating the first standardized market for gold price discovery. Silver futures had traded since 1963. Now both metals existed in the same institutional infrastructure. Large investors gained the ability to express views on the ratio through leveraged futures positions. The modern era of gold-silver ratio analysis began. The fundamental difference between gold and silver demand creates the ratio's predictive power. Gold functions primarily as a monetary asset. Central banks hold 36,000 metric tons of gold in their reserves, valued above $2.5 trillion according to IMF data. No central bank holds significant silver reserves. The last major official silver holdings disappeared in the 1960s when the U.S. Treasury sold its stockpile to suppress prices for coinage. This institutional preference matters. When financial stress rises, central banks buy gold. When commercial banks seek collateral, they accept gold. When sovereign wealth funds hedge currency risk, they acquire gold. Silver receives none of this institutional demand during crises. It flows in the opposite direction. Silver demand splits between investment and industry in a ratio gold does not share. World Silver Institute data shows investment demand accounting for only 15 to 25% of annual silver consumption. Industrial demand consumes over 50%. Solar panels use silver for their conductive properties. Electronics require silver for circuit boards and connections. Medical devices depend on silver's antibacterial characteristics. Photography, though declining, still consumes silver halides. Gold faces no comparable industrial exposure. World Gold Council reports show jewelry and investment absorbing 75 to 85% of annual gold supply. Industrial uses account for less than 10%. When recession threatens, industrial demand for silver collapses. Factories reduce production. Solar installations slow. Electronics manufacturing contracts. Silver prices fall. Gold experiences the opposite effect. Recession fears drive investment demand higher. Central banks accelerate purchases. Individual investors buy coins and bars. ETF holdings expand. Gold prices rise or hold steady while silver falls. The ratio expands. This structural asymmetry creates the ratio's value as a crisis indicator. Rising ratios signal institutional rotation from industrial exposure toward monetary safety. The speed and magnitude of ratio expansion measures the intensity of institutional fear. A ratio moving from 60.1 to 70.1 over 6 months signals moderate concern. A ratio moving from 80.1 to 125.1 in 6 weeks signals systemic panic. The ratio also measures recovery. When crises pass, industrial demand returns. Factories restart production. Solar installations resume. Electronics manufacturing expands. Silver prices rise. Gold prices stabilize or retreat as fear subsides. The ratio contracts. Movement from 80.1 toward 60.1 signals economic recovery and restored confidence in industrial assets. Traders who understood this structural dynamic in 1975 possessed an edge their competitors lacked. They read institutional behavior through a single number updated daily on COMEX settlement reports. This edge persisted for 50 years. It remains active today. The gold-silver ratio faced its first major test between 1979 and 1982. Nelson Bunker Hunt and William Herbert Hunt, sons of oil billionaire H.L. Hunt, attempted to corner the global silver market. Their actions drove the ratio to extremes in both directions, providing the first demonstration of its crisis prediction capabilities. By late 1979, the Hunt brothers and their associates controlled an estimated 200 million ounces of silver through futures contracts and physical holdings. This represented over half the world's deliverable supply. Silver prices rose from $6 per ounce in early 1979 to $49.45 per ounce on January 18, 1980. Gold prices also rose during this period, climbing from $226 to $850 per ounce. The gold-silver ratio collapsed to 17.1, its lowest level since free market trading began. The low ratio signaled extreme conditions. It did not signal crisis in the traditional sense. It signaled a speculative mania in silver, creating artificial price relationships. The ratio served as a warning indicator in reverse, showing silver overvaluation rather than gold flight. COMEX and the Chicago Board of Trade responded by changing their rules. On January 7, 1980, the exchanges imposed position limits and increased margin requirements. They banned new long positions in silver, allowing only liquidation orders. These rule changes, made by exchange gatekeepers, broke the Hunt corner. Silver prices collapsed 50% in 4 days. On March 27, 1980, silver fell from $21.62 to $10.80 per ounce. This day became known as Silver Thursday. The Hunt brothers faced margin calls exceeding $100 million daily. They approached insolvency. The gold-silver ratio exploded from 17:1 to 40:1 within weeks. This expansion signaled the return to normal market function after an artificial compression. It also signaled the vulnerability of silver to institutional manipulation and regulatory intervention. Gold faced no equivalent attack. Gold held its gains while silver surrendered its speculative premium. The Federal Reserve intervened to prevent the Hunt collapse from spreading to major banks. A consortium led by the Fed organized a $1.1 billion bailout to cover the Hunt's margin obligations. This intervention established a precedent repeated in 2008 and 2020. Financial authorities would act to prevent cascading failures, socializing losses, while preserving institutional infrastructure. The ratio continued expanding through the early 1980s as Federal Reserve Chairman Paul Volcker raised interest rates to combat inflation. Gold prices fell from $850 to $300 per ounce by 1982. Silver prices fell further, dropping to $5 per ounce. The ratio reached 65.1, reflecting tight monetary policy and weak industrial demand during the 1981 to 1982 recession. Academic researchers began documenting the ratio's behavior during this period. The first peer-reviewed studies on precious metals and financial stress appeared in the mid-1980s. Researchers at the London Business School published early work on gold's safe haven properties. These studies established the theoretical framework for understanding why gold and silver diverged during crises. The ratio's expansion to 65.1 during the 1981 to 1982 recession demonstrated its sensitivity to economic contraction. Industrial silver demand fell as manufacturing output declined. Gold held value better because its demand came from investors seeking inflation hedges and monetary stability. The ratio captured this divergence automatically, requiring no subjective interpretation. By 1983, the ratio began contracting as the economy recovered. Industrial production increased. Silver demand rose. The ratio fell to 51 by 1985 and continued declining through the remainder of the decade. Traders watching this contraction identified economic expansion before official statistics confirmed the trend. The Hunt brothers episode taught several lessons about ratio analysis. First, extreme ratio compression below 20.1 signals speculative excess in silver, not fundamental value. Second, regulatory intervention in precious metals markets occurs when positions threaten systemic stability. Third, gold maintains institutional support during silver liquidations because central banks and commercial banks prefer gold collateral. Fourth, ratio expansion after artificial compression accelerates faster than the original compression as forced selling overwhelms natural buyers. These lessons apply directly to subsequent crises. The ratio's behavior in 1980 established the template for 2008 and 2020. Compression signals speculation or complacency. Expansion signals fear and institutional rotation. The speed of movement indicates the severity of underlying stress. The data from 1979 to 1982 provided the baseline for all future analysis. The gold-to-silver ratio began signaling trouble in 2006. Most observers focused on rising home prices, expanding credit, and record corporate profits. The ratio told a different story. It started climbing from 45.1 in early 2006 toward 55.1 by late 2007. This 20% expansion occurred while equity markets reached new highs. The divergence indicated institutional positioning invisible to headline readers. COMEX data showed the composition of ratio expansion. Commercial traders, the category including banks and dealers, increased gold futures positions while reducing silver exposure. Managed money, the category including hedge funds and commodity trading advisors, showed similar rotation. These institutional flows appeared in commitment of traders reports published weekly by the Commodity Futures Trading Commission. The data sat in public archives. Retail investors ignored it. Bear Stearns collapsed in March 28. The gold-silver ratio stood at 52-1 when Fed-orchestrated merger with J.P. Morgan Chase saved the firm. By the time Lehman Brothers filed bankruptcy on September 15, 2008, the ratio had reached 70. 1. The 35% expansion from early 2006 levels quantified the growing institutional fear building inside the financial system. The ratio's acceleration matched the crisis timeline precisely. It crossed 60.1 in July 2008, 2 months before Lehman. It crossed 70.1 the week Lehman failed. It reached 84.1 by October 2008 as the global banking system teetered. Each level corresponded to a documented stage of the financial crisis. Gold prices rose from $635 per ounce in early 2008 to $870 by October 2008. Silver prices fell from $16.50 to $950 over the same period. The ratio captured this divergence in a single number. Gold gained 37% while silver lost 42%. The 84.1 ratio reflected the magnitude of institutional flight to monetary safety. Research published after the crisis confirmed the ratio's predictive value. Bohr and McDermott's 2010 paper in the Journal of Banking and Finance documented gold's safe haven properties during financial turmoil. The regression analysis showed gold generating positive returns during equity market crashes, while other commodities, including silver, declined with stocks. The gold-silver ratio expansion captured this statistical relationship in real time. The Federal Reserve responded to the 2008 crisis with unprecedented monetary expansion. The Fed's balance sheet grew from $870 billion in August 2008 to $2.2 trillion by November 2008. Interest rates fell to zero. Quantitative easing began. These actions, announced publicly, signaled to ratio watchers that recovery would follow crisis. The ratio peaked at 84:1 in October 2008 and began contracting almost immediately. By April 2011, the ratio had fallen to 31:1. Silver prices rose from $9.50 per ounce to $49 per ounce. Gold prices rose from $870 to $1,550. Both metals gained, but silver outperformed gold by 400% during the recovery phase. Traders who understood the ratio pattern in 2009 recognized the setup. Crisis ratios above 80.1 had reverted toward 50.1 or lower after every previous panic. The Fed's monetary response guaranteed reflation of asset prices. Silver's industrial component would benefit from economic recovery. Gold's safe haven premium would decline as fear subsided. The ratio trade offered asymmetric returns to those who read the historical pattern. The 2008-2011 cycle established the modern template for ratio analysis. Expansion above 70.1 signals severe financial stress. Expansion above 80.1 signals systemic crisis. Contraction from these levels indicates policy response and economic recovery. The pattern repeats because the structural difference between gold and silver demand remains constant. Only the magnitude and timing vary. St. Louis Fed researchers later correlated the gold-silver ratio with their financial stress index. The correlation exceeded 0.7 during crisis periods, indicating strong statistical relationship. The ratio led the financial stress index by an average of 3 months during major market dislocations. This lead time offered actionable information to investors monitoring ratio movements. The 2008 crisis demonstrated why ratio analysis works when other indicators fail. Equity markets showed no warning until September 2008. Credit spreads widened only weeks before Lehman collapsed. The gold-silver ratio began expanding 2 years before the crisis peak. It measured institutional positioning before those positions appeared in price movements or credit metrics. It captured the slow accumulation of fear invisible to traditional market analysis. The gold-silver ratio entered 2020 at 85:1, already elevated by historical standards. Trade war concerns between the United States and China, Brexit uncertainty, and slowing global growth had pushed the ratio above its long-term average of 60. 1. Institutional positioning reflected heightened caution before any pandemic headline appeared. COVID-19 emerged in Wuhan, China in December 2019. Western markets largely ignored early reports. The ratio remained stable between 85:1 and 87:1 through January 2020. It began accelerating in February as supply chain disruptions in China spread to global manufacturing. By February 28, 2020, the ratio crossed 90.1. March 2020 produced the fastest ratio expansion in recorded history. The number moved from 90.1 to 125.1 in 18 trading days. This represented a 39% expansion during a period when equity markets fell 34% from peak to trough. The ratio captured institutional panic with unprecedented precision. Silver prices collapsed from $18 per ounce to $12 per ounce during March. Gold prices declined briefly from $1,780 to $1,470 before recovering to $1,720 by month end. The ratio's expansion came from silver's faster decline, not gold's advance. Industrial demand evaporated as factories closed worldwide. Investment demand for gold remained steady as central banks signaled unlimited support. The 125.1 reading exceeded any prior level in financial market history. COMEX records dating to 1975 showed nothing comparable. Academic research extending to ancient price records found no equivalent. The ratio had never reached 100.1 in any documented market from Mesopotamia to modern New York. The March 2020 extreme reflected unprecedented institutional fear of economic collapse. Federal Reserve actions during March 2020 dwarfed the 2008 response. The Fed cut interest rates to zero on March 15th. It announced unlimited quantitative easing on March 21st. It established lending facilities for commercial paper, corporate bonds, municipal bonds, and Main Street businesses. The Fed's balance sheet expanded from $4.2 trillion to $7.2 trillion within 3 months. The ratio peaked on March 18, 2020 at 125.7 to 1. This date coincided with the equity market bottom and preceded the Fed's unlimited QE announcement by 5 days. The ratio signaled the crisis peak before policy response became public. It began contracting immediately, falling to 110.1 by April 1st and 97.1 by May 1st. The contraction accelerated through summer 2020. By August 2020, the ratio had fallen to 69.1. Silver prices rose from $12 to $28 per ounce, a 133% gain in 5 months. Gold prices rose from $1,470 to $2,060 per ounce, a 40% gain. Silver outperformed gold by 90 percentage points during the ratio contraction phase. The pattern matched 2008-2011 with compressed timing. Crisis expansion, peak ratio, policy response, and rapid contraction occurred within months rather than years. The speed reflected the magnitude of policy intervention. The Fed's 2020 response exceeded the 2008 response by trillions of dollars and arrived faster. The ratio contracted faster because reflation arrived faster. Investors who recognized the March 2020 ratio extreme as a buying signal for silver captured generational returns. The asymmetry favored silver over gold because silver had fallen further during the panic. Silver's industrial demand would recover as economies reopened. Gold's safe haven premium would decline as fear subsided. The same structural factors driving the 2009-2011 trade applied to the 2020-2021 trade with greater magnitude. World Silver Institute data confirmed the demand recovery. Industrial silver consumption rebounded 9% in 2021 as manufacturing production recovered globally. Solar panel installations, a growing component of silver demand, increased 22% in 2021. Investment demand remained elevated as inflation concerns replaced pandemic concerns. Total silver demand exceeded supply in 2021 and 2022, creating physical deficits supporting prices. The 125.1 extreme established a new upper boundary for ratio analysis. Prior crisis, peaks near 80-85.1 now appeared moderate. The 2020 reading showed the ratio as capacity to reach levels previously considered impossible when institutional fear reaches systemic proportions. Future crisis analysis must account for this expanded range. Central bank responses also established new precedents. The Fed's willingness to purchase corporate bonds and support municipal debt markets demonstrated expanded intervention capacity. Future crises will likely trigger similar responses, shortening the recovery timeline and accelerating ratio contraction. The 2020 pattern suggests extreme ratio readings above 100.1 represent buying opportunities for silver, assuming policy response follows historical precedent. The gold-silver ratio provides real-time information about institutional positioning available to any investor with internet access. You read it by dividing the current gold price by the current silver price. Gold at $2,400 per ounce and silver at $28 per ounce produces a ratio of 85.71. This calculation requires no special software, subscription service, or professional training. Current ratio levels carry specific implications based on the 50-year pattern. Readings between 60.1 and 70.1 indicate normal market conditions, with balanced institutional sentiment. Readings between 70.1 and 80.1 indicate elevated caution and institutional preference for gold over silver. Readings above 80.1 indicate significant financial stress. Readings above 100.1 indicate systemic crisis. The ratio has traded between 75.1 and 92.1 since 2022. This elevated range reflects persistent inflation concerns, banking sector stress, including the Silicon Valley Bank and First Republic failures, geopolitical tensions, including the Ukraine war and Middle East conflicts, and uncertainty about Federal Reserve interest rate policy. Institutional positioning shows continued preference for gold's monetary characteristics over silver's industrial exposure. Central bank gold buying provides additional context for ratio analysis. According to World Gold Council data, central banks purchased over 1,000 tons of gold in both 2022 and 2023, the highest levels since records began in 1950. China, Poland, Turkey, and India led purchases. These flows support gold prices, while silver receives no equivalent institutional demand. Central bank buying suggests sustained elevated ratios until this purchasing trend reverses. The ratio's current level offers specific guidance for asset allocation. Elevated readings above 80.1 suggest silver holds greater upside potential than gold during eventual ratio contraction. The historical pattern shows ratios above 80.1 reverting towards 60.1 during recovery phases. This reversion requires silver outperformance relative to gold. An investor seeking precious metals exposure captures more upside potential through silver at elevated ratio levels. Risk factors modify this analysis. Silver's industrial exposure means economic recession reduces silver demand. A ratio above 80.1 rising toward 100.1 indicates worsening conditions, not immediate buying opportunity. The 2020 experience showed ratios peaking during maximum crisis severity. Early silver purchases before crisis completion result in further losses before recovery begins. COMEX commitment of traders. Data supplements, ratio analysis with positioning information. Commercial traders, including banks and dealers, show net long or short positions in gold and silver futures. Extreme commercial long positions in silver historically precede price advances. Extreme commercial short positions precede price declines. Combining ratio analysis with positioning data improves timing accuracy. The St. Louis Fed FRED database offers free tools for ratio analysis. You chart the gold-silver ratio against economic indicators, including unemployment, GDP growth, and inflation. You identify correlation patterns specific to your investment thesis. The data extends back decades, allowing backtesting of trading strategies against historical outcomes. Physical market data from the World Gold Council and Silver Institute provides fundamental context. Gold supply grows approximately 1 to 2% annually from mine production. Silver supply grows at similar rates. Demand patterns determine price movements within these supply constraints. Rising investment demand for gold during crises explains gold price resilience. Falling industrial demand for silver during recessions explains silver price weakness. The ratio captures these demand divergences. Your investment decisions benefit from ratio awareness, regardless of precious metals allocation. The ratio signals broader institutional sentiment about economic conditions. Rising ratios warn of increasing financial stress. Falling ratios signal improving conditions and risk appetite. This information applies to equity, bond, and real estate decisions beyond precious metals positioning. The 50-year record demonstrates the ratio's consistency across different crisis types. The 1980-1982 recession, the 1987 stock market crash, the 1998 Asian financial crisis and LTCM collapse, the 2000-2002 dot-com bust, the 2008 global financial crisis, and the 2020 pandemic crash all produced ratio expansion followed by contraction. The pattern persists because the structural difference between gold and silver demand persists. Central banks hold gold. They do not hold silver. This institutional preference creates the crisis dynamic the ratio measures. The Federal Reserve published research in 2023 examining precious metals as financial stress indicators. Their analysis confirmed the gold-silver ratio correlation with their financial conditions index. The correlation exceeded 0.65 during periods of elevated stress. The Fed's own research validates the indicator's relevance for monitoring systemic risk. You now possess the framework for reading the ratio yourself. The number appears on any financial website showing gold and silver prices. You calculate it with elementary division. You interpret it using the thresholds established by 50 years of data. Readings above 80.1 signal caution. Readings above 100.1 signal crisis. Readings falling from elevated levels signal opportunity. The institutions managing trillions of dollars monitor this ratio constantly. Their analysts track the same COMEX data, the same central bank purchases, and the same supply-demand reports discussed in this presentation. They act on ratio extremes before retail investors notice price movements. They position portfolios using information available to everyone but analyzed by few. Your awareness of the gold-silver ratio places you among the informed minority. The pattern has repeated for 50 years. The structural factors driving the pattern remain in place. Central banks continue buying gold. They continue ignoring silver. Industrial demand continues driving silver volatility. Investment demand continues driving gold stability. The next crisis will expand the ratio. The recovery following that crisis will contract it. The cycle continues because the underlying dynamics continue. The 125.1 reading in March 2020 marked the most extreme institutional panic in 5,000 years of precious metals history. The ratio contracted to 65.1 within 18 months. Silver prices rose 133% during that contraction. The pattern provided returns unavailable through any other asset class. The next crisis will provide similar opportunity to those prepared to recognize it. You found Rashi historical. The official story is the first lie. The money trail is the first truth.